Well, hi everyone. Welcome to the Buffett and Beyond ETF report. And this is June 15th, 2024. Record new highs in the QQQs and the NASDAQ and the S&P again. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at some of our ETFs. In the first one of the QQQs, and right over here we broke through those highs. We tested those highs right in here and then gapped up, and right now we're going to go, or we are up, and look up here, we are now overbought, so we have to be very, very careful in here. When we come all the way down to our intermediate term indicator, we got past this point, which is very, very good, but look how overbought we are. So we're getting into a spot where, okay, we're due for some type of pullback here. And there's lots of analysts that are saying buy any pullback, and other analysts are saying, well, we could go down even further. But whatever the case, we'll know it once these indicators turn around. And when we look at the S&P 500, same story. Here we were at previous highs, and then we broke through those highs, tested them for about 4 or 5 days, and then all of a sudden gapped up on good news, CPI, the Consumer Price Index report, and the PPI. So the Producer Price Index all came in better than expected, which means inflation is going down. And we can see back up here when we put a longer time frame on this indicator that we are at a situation where we are overbought. So we'll just have to wait and see what happens. Down here, same thing. We want to get past this area in here. Now, again, this is the S&P 500, and we'll see. Right now, as I'm recording this on Friday afternoon, we're down a bit, so we'll see what happens coming into or going into next week. And when we look at the Dow Jones Industrial Average, well, we had this double bottom in here after a pretty decent pullback in here. Then we had a pretty decent rally to another high in here. And guess what, folks? Now we're coming down and rallied a little bit. And now we are falling this past week when the other indices did really, really well. So we're worried about this Dow Industrials, and we have to look at something else in here. Let's look at the transportation, because the transportation, you need the transportation to go up for the market, for the Dow to go up, because the transportation tells you whether they are carrying more goods to be manufactured, because the retailers are saying people are buying, we need more product. And right now the transportation index is telling us that we don't have that yet. The economy is slowing, and so therefore we get the transportation index down here testing this low in here. And as I said, this is Friday afternoon, so we will see. Looking at this indicator here, we don't like this downward slope and this black line turning down in here. So we will just have to wait and see what happens next week. And this transportation index is telling us we're holding back until we see those orders. We're not going to put more trucks on the road or more railroad cars on those trains until we get the orders to put something in them. So that's what we're waiting for, folks. The economy is definitely slowing to a point, and which makes it easy for the Federal Reserve, because sooner or later they're going to lower that interest rate. And when we look at the housing sector, well, the housing sector is kind of stalled out in here and actually has declining highs. And we'll see what happens, because with interest rates, or since they've gone up, then housing permits, housing starts, and there is a housing shortage, don't forget that. So we will see what happens with this home builders ETF, because we bought some stocks in some of our portfolios out of this ETF, some of the better stocks. Why wouldn't you buy the better stocks? But we bought some of the better stocks, and we're waiting. And look down here, we're waiting for this to turn around, and it looks like it's turning up, doesn't it? And so we have this slightly upward, and I say slightly upward line in here, and we're looking at these two bottoms here and here. And right now, this is telling us it's slightly stronger than it was last time it was down this far. But we are oversold, and they're just waiting for that one shoe to drop, which would be a nice interest rate cut. And some analysts are saying we won't see that until December. after the election. You see a little political playing around in there, but the Federal Reserve has been pretty good at staying out of politics. So Fed Chair Powell is doing a very, very good job. He's threading that needle so we don't go into recession, but yet we're slowing down inflation. And that's what this week's numbers were all about. Now, when we go to healthcare, oh my gosh, healthcare just can't seem to get out of its way. So it's doing the same thing over the past couple of months that a good part of the rest of the market, except tech, the rest of the market is doing, which means it's not doing anything. Had that correction in there, bounced up, came back down, bounced up again, testing this high in here. But when we look down here with this indicator pointing down, even though it's made a equally high in here, this indicator is pointing down. So if it keeps going down this coming week, this is a little sell signal on the healthcare. The healthcare has just been weak, except for this nice rally in here. But after that, it's been weak, and some of those stocks are just not doing well. And let's look at the sector stars, our own ETF. Now, it's not a publicly traded ETF, but our portfolio, we take the best in the best sectors and put those stocks in there. And first thing we want to see or look at is that this is up almost 6% since last week, up 26.4% with the S&P up 13.9%. So we're looking at a doubling of the S&P 500, and the S&P 500 is doing very, very good, folks. Now, over here, we have the hedging of using the SQQQs, and that's the triple inverse ETF of the QQQs, which is the NASDAQ 100 stocks minus any financial stocks. And so we are hedged 30%. But the difference is we're timing those hedges here. So when we see a rise in the market, and if it's sustained at all, we'll be out of our hedges and we'll be long the QQQ. So in other words, we sell the SQQQs. If we made money on it, whatever money we made, we'll buy the QQQs for hopefully the rise up. Now over here, we're constantly hedged. And as you know, the QQQs are down 35% this year, but we only have 10% of our portfolio in it, but it represents, since it's a 3-to-1 inverse, it represents 30%. So it has lost 10% off of these returns in here. So bottom line is that the top sector star, or the sector stars, up 26.4%, which is phenomenal. We're only in June here, folks. And if we're timing the hedges, we're up 24.3%. And over here, if we're constantly timed, we're up 13.4%, which is about the same as the S&P, but we are 30% hedged all the time. Now, let's look at something in the sector stars here. We sold Tesla. So Tesla gave us a 32% loss this year. And with that money, we bought 3 housing stocks. Maybe a little bit prematurely, but they're doing pretty decent. So the key is we don't like to change stocks during the middle of the year. We like to do it between Christmas and New Year's. The market is kind of at its high. Everybody's happy. And between Christmas and New Year's is when everybody is out partying, visiting people, and the volume on the market goes down. So it's a good time to make your changes. And so the key is that, okay, if we make changes during the year, is it a good time to do it? Because we sold Tesla with the 32% loss. Now the key, and that's there, that we can't do away with that, except the stocks that we bought with it are up. So the key is, what are these stocks up on average? So you have to average them out because they average one stock. Tesla was one position, and we bought 3 stocks with it. So these 3 stocks have to equal Tesla. So if you say, well, we're up about 21% overall on these three stocks, divided by three, because we're talking about one position, it's up about 7%. But what did Tesla do in between that? Tesla went up to 26%, or it went up, but still down 26.6%. But when we sold it, we lost 32%, and that's about 6%. So we're looking at, we would have gained back 6% on Tesla. Instead, we gave it up for three stocks, which on average gained us 7%. So we're up a whopping 1% over that change that we made. So this is one of the few times that we've made changes during the middle of the year, and this is one of them. And folks, we're up 1% on that change that we made. So we'll see what happens. But remember, we're up, no matter how you look at it, we're up 26.4% without hedging. With timing of the hedges, we're up 24.3%, which is almost double the S&P 500 and much higher than the QQQs themselves. And if we're hedged all the time, we're up 13.1%, almost as much as the S&P 500. So we're doing well no matter what we're doing. Okay, let's look at the home builders. The home builders had a little bit of a rally this week. They're up 18.7% for the year, which is 5% more than last week. So the top stocks are ahead of the home builders ETF. 18.7% for our top stocks, 10.5% for the home builders ETF. So it just goes to show that if you pick the right stocks in an ETF, pick the above average stocks, and because the ETF has above average stocks and below average stocks. So we like to pick the above average stocks, which I hate to say it's common sense, but it is. You just have to know how to pick those stocks, and we use the clean surplus methodology. So up 18.7% with the home builders total ETF up 10.5%. We're doing well, folks, almost doubling the ETF itself. And let's look at the QQQs, which is pretty much my favorite portfolio, up 30.7%. It's up a little over 3% from last week, where our all-stars were up, 7 or 8%, 7% or so. Now with timing, we're up 31% because with the timing, we actually went long with the QQQs after we sold the SQQQs for this rally up. So we actually gained a little bit here. So timing actually gave us more than just buying those stocks long. And don't forget, if the market retreats, and we catch that retreat by using our timing, which is the SQQ, the triple inverse, and we'll be doing very, very well. We're doing very, very well now. And if we're constantly hedged, we're up 17.3%, which is very nice, folks. It's better than the all-stars that is hedged all the time, which is up a little over 13%. So this portfolio that I like, the NASDAQ 100 top stocks, and don't forget, we have that loss in Tesla, so we still have that loss in there, and we have to keep it there because it was a loss. And can you imagine what we've been doing without that loss? But anyway, we're up 30.7%, 31% with timing, because the timing is actually making us money on the hedges a little bit. And hopefully that in any downturn we get, we will be hedged. We'll catch that turn and be hedged partially at 30% of the portfolio on the way down. So, folks, we had a very, very good week this past week. All the indices did good except the Dow. The Dow fell just about every day, while the S&P and the QQQs were up just about every day. So we had a good week. We made money. You go out, you be on the beach, take it easy, be with your family, sit and watch television, whatever you want to do. Take your mind off the market, because guess what? It'll be back open on Monday. And, folks, yep, our daily letters will be out starting Tuesday, and we'll be with you all week long. Okay, folks, see you next time. Stay safe.